Picture this. You're standing on the edge of a financial cliff, watching as trillions of dollars vanish into thin air. The ground beneath your feet is crumbling, and the world's economies are in free fall. This isn't a nightmare. It's the reality of the 2008 financial crisis. And here's the kicker. It could happen again. Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. The 2008 financial crisis was just a blip on the radar of American economics. It was a global earthquake that shook the very foundations of our financial system. Its aftershocks are still felt today. It's making it crucial for modern investors to understand what went wrong and how to protect themselves in the future. Let's start by breaking down why this crisis matters more than a decade later. The 2008 meltdown was just about numbers on a screen. It was about real people losing their homes, their jobs, and their life savings. It exposed the fragility of our interconnected global economy and the dangers of unchecked financial innovation. Today's markets still face similar risks: bubbles waiting to burst, mountains of debt, and the siren song of get-rich-quick schemes. The fallout was staggering. Trillions in wealth evaporated overnight. Unemployment skyrocketed around the world. Banking giants that once seemed invincible crumbled like sandcastles. Governments had to step in with unprecedented bailouts just to keep the lights on. Some countries took years to recover, a stark reminder of how a crisis in one part of the world can spread like wildfire. So, what lit the fuse of this financial powder keg? It all started with the American dream of home ownership. Banks were handing out mortgages like candy, even to folks who couldn't afford the payments. Why? Because everyone thought housing prices would keep soaring forever. Spoiler alert, they didn't. But it wasn't just overeager homebuyers at fault. Banks took these risky mortgages and turned them into complex financial products that spread the risk throughout the global system. It was like taking a virus and putting it into the world's water supply. When the housing market sneezed, the whole world caught a cold. Meanwhile, regulators were asleep at the wheel. Years of financial deregulation had given banks free rein to take massive risks with little oversight. Credit rating agencies, who were supposed to be the watchdogs, were instead handing out top ratings to ticking time bombs. It was a perfect storm of greed, ignorance, and misplaced trust. The moment of truth came in September 2008 when Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. It was like watching a financial Titanic sink, and it sent shockwaves through the global economy. Suddenly, no one knew who to trust. Banks stopped lending to each other, fearing that everyone might be sitting on a mountain of toxic assets. As credit markets froze, the effects rippled through every sector of the economy. Businesses couldn't get loans to operate. Consumers couldn't borrow to buy homes or cars. Stock market went into freefall, wiping out retirement savings and investment portfolios. Companies started laying off workers in droves, and consumer confidence hit rock bottom. Faced with economic Armageddon, governments around the world sprang into action. In the U.S., programs like TARP pumped billions into failing banks and corporations. It was controversial. Many saw it as rewarding the very institutions that caused the crisis. But supporters argued it was necessary to prevent a complete collapse of the financial system. Central banks, led by the U.S. Federal Reserve, slashed interest rates to near zero and started buying up assets to inject liquidity into the markets. It was like giving the economy a massive adrenaline shot. For the first time in history, we saw global coordination between central banks, all working together to keep the world economy from flatlining. So what can today's investors learn from this financial horror story? First and foremost, diversification is your best friend. Putting all your eggs in one basket, whether it's real estate, stocks, or the latest crypto craze, is a recipe for disaster. Spread your investments across different sectors, regions, and asset types to cushion yourself against market shocks. Next, respect the power of debt. Leverage can amplify your gains, but it can also magnify your losses to catastrophic levels. Whether you're an individual investor or a massive institution, always be mindful of how much you're borrowing and whether you can weather a downturn. Avoid getting caught up in the hype. The housing bubble was fueled by a fear of missing out. Everyone wanted to cash in on the seemingly endless rise in prices. But markets can turn on a dime. Following the herd without doing your own analysis is a surefire way to get trampled when things go south. Perhaps most importantly, keep a long-term perspective. Investors who panicked and sold everything at the bottom of the crash locked in their losses. Those who stayed the course and kept investing through the downturn eventually saw their portfolios recover and grow. Patience isn't just a virtue in investing. It's often the difference between success and failure. Looking at today's market, it's hard not to see echoes of 2008. We've seen massive run-ups in tech stocks, cryptocurrencies, and even certain real estate markets. There's a familiar feeling of this time it's different in the air. But history has shown us that when everyone thinks the party will never end, that's usually when the music stops. So what should savvy investors be watching out for? Keep an eye on debt levels, both in the overall economy and in the companies you invest in. Be wary of assets that seem wildly overvalued compared to their fundamentals. Always be prepared for the possibility that easy money policies from central banks could change, potentially popping bubbles that have formed. Building a resilient portfolio means learning from the past. It's diversified not just across asset classes, but across strategies. Have a plan for how you'll react to market volatility before it happens. Always keep some dry powder, cash or stable assets to take advantage of opportunities when others are panicking. As we wrap up this journey through one of the darkest chapters in modern financial history, let's remember the biggest lesson of all. Everything is connected. In our globalized world, a problem in one corner of the financial system can quickly become everyone's problem. Small risks left unchecked can snowball into systemic crises that affect millions of lives. Studying past crises isn't just an academic exercise. It's a crucial tool for future success. While history may not repeat itself exactly, it often rhymes. By understanding the mistakes of 2008, we can spot similar patterns forming today. We can resist the siren song of easy riches during market euphoria. Most importantly, we can build financial strategies that don't just survive the next crisis, but thrive in its aftermath. Remember, in the world of finance, knowledge truly is power. By learning from the past and staying vigilant in the present, we can all work towards a more stable and prosperous financial future. Thanks for joining us on this deep dive into the 2008 financial crisis. Stay savvy, stay informed, and keep building your wealth wisely.